again, late assignments and exams are accepted without penalty. So if you come in late, that's fine. Today we're going to finish the Chapter 8 handout, and we're also going to have one that's kind of a miscellaneous handout for some Chapter 8, but Chapter 9 too. And then tomorrow, I will email you guys the Chapter 8 and Chapter 9, and it will be due on the 21st. Okay, so let's go ahead and let me open up my one from last time. I think we did LIFO FIFO, if I remember correctly. Oh, we didn't do those, what, 5 and... I'll put those up later, 5 and 8. But what I'm going to get to, I'll go ahead and get to I'll put those other ones up in I tell you what, on break, I'll put those in. You can check your answers. Okay, let's go to number 9, average cost. Average cost is sort of like in between LIFO and FIFO in that it takes all the costs and averages them. So you end up getting a per unit cost, and that cost, you simply multiply it by the number of items you sold for your cost of goods sold, and then you also multiply it by how many items are in your ending inventory, and that gives you your ending inventory. So it's really just one number. Everything gets added in. Whenever you purchase something, it'll get thrown in to the average. So that's what we're going to do right now. Okay, so average cost. Well, I tell you what, before we go too far, let's go ahead and get the sales in. Do something here. Okay, sales are easy. Let's do the easy part first. Okay, so our sales, we had 120 at 40. It's exactly the same as before. I said that wrong. 120 at 40. Oops. $40 each. And so this will equal our total sales. 4,800. We're going to use Mr. Calculator. Yes, 4,800. Okay. So this is our dollar sales with 4,800. Now for the hard part. What we're going to do is take the average cost of these. So the first thing we're going to do is get our totals here. Okay, so units sold, we had 160 plus 40 equals 200. And we need to get the total cost. So we're going to take our total cost and divide it by this 200, and that'll give us our per unit. Okay, so 160 times 21. I'm going to change this to times. I know it's the same thing, but so we need the total cost. So 160 times 21. Uh, 3360. And our 40 at 25. Oops. 1,000. Yeah. Okay, so that's 1,000. Oops. Let's try that again. Okay, so this will be $4,360. Okay, so this is what we want. Then we're going to take our to use for our average. Now you might be saying, well, why can't we just add those, add the 21 and the 25 together and average that? You can't do that because you have if you had the same amount of units, you could, but we don't. We have a lot more at the 21 than we have at the 40. So you just multiply them out and it'll do the weighting. But so here's the total cost, and we're going to divide it by the units. What do I want to do? I can do it over here, I guess. Yeah, I can do it down here actually. 4360. Divided by 200 units equals, okay, that I don't know. $21.80. So this is our average cost per unit is that 2180. And that again is taking how much you guys like me to bring out these arrows, because boy are they fun. Okay. So we got our average cost per unit. Now, let's see something real quick. How do I put it in over here? Okay. And I gotta get rid of these arrows. They're bugging me. Oh, I know. I'll move this up. Okay, so I'll put it down here. Cost of goods sold. Uh, units. Now they're all going to go at the same price. So we sold 120 units. We're going to take 120 times our average cost. $120 times 2180. $26.16. So this is our total cost of goods sold. It's just one number. I'm gonna stop it. Any questions on this? So you just take the total cost and the total units and um, divide the total cost into the total units. For those of you that do if you do any kind of coding or anything like that for IT or anything like that, um, doing LIFO and FIFO are really a pain because every time you make a purchase, it's for a different amount, usually a different quantity. You have to have a different variable for everything. So if you make 200 purchases in a year, you're going to have 200 new variables. Average cost is the easiest one to program because whatever the cost was, that goes in the total cost. Whatever the units were, go along with in the units. You just need two variables. It's a very easy one to computer code. And I always wondered, because a lot of companies switch to average cost when they got computers. I wonder if that was it. It's like, well, it's so much easier to program. Who cares about whether it's the right thing to do? It's, man, is it easy to program? And for all that stuff like inventory and that, you're really talking about timing issues, the differences between them. It's all going to go through the income statement at some point in the balance sheet, but it's just a timing difference. Okay. Calculate the gross profit. Let's see, we had sales, 4,800. Minus our cost of goods sold, which we just calculated was and so that'll give us our gross profit or our gross margin. Hold on. 2184. Question on that? So here's our sales. The units will always match up with our cost of goods sold. We sold 120 units. We have to figure out what the cost was for those. The average cost was 2180. So that's it. Okay, now for the big question, how many units were not sold? We know how many were sold. Sold 120.
80 should be left, right?
Yep. Yeah, we had 200. We sold 120, so there are 80. Yeah, yep, that is true, Vanessa. So this will be let's see, going down here to ending inventory. We'll put it one line. Oops. So any inventory, these are things that are not sold. We still have them. You can go out there and look at them in the inventory. Oops. So 80. I'm gonna put it down here to the calculations for that. We had 200 units. So the unsold were the 80. And this is the average cost per unit. I would say, maybe I can fit it in here. Oh, I know what I'll do. I'll move it down. It's gonna mess up my spacing though. I'm gonna put an average. You guys will know what it is. It's the same number, 2180. And this would be whatever the total. Um, if you're wondering why I keep grouping messing up, it's partly because I'm old, but also partly because I've got the lighting in here down so I can't see anything. I can't see my keyboard, so I don't know where my hands are until I hit the key and I go, oh, it's not, that's not it. All right, so let's see, 80. Ooh. 1744. So that would be our ending inventory. Our cost of goods sold would be 21, or excuse me, 2616, and our ending inventory would be 1,744. You may want to check those to make sure. And that's it. That's it for the average. So the average. Now, the average suffers a little bit of what the last in first out suffers, in that you will get at least part of the cost of the inventory. It will be on the books forever, kind of thing. You know, if you keep taking the average, well, part of that average is going to be from 50 years ago, unless you sold out the entire inventory at some point, then it would start over. But you could also have these costs from many, many years ago hanging around in that average, that albeit probably a very, very small amount, it's still there. So that's why some people, it, for some companies and some people that do accounting, it's kind of frowned upon because of that. Excuse me. I think that most places in most countries they think that the FIFO is probably the best one because it clears out the inventory. Um, usually in a very very short period of time. These are timing differences that the current ones become the ones you sold, where you don't actually have that in the average cost. Even the cost of goods sold will have some of the really old numbers in it. It could have something going back to the 50s or something. So anyway, the average cost does suffer a little bit theoretically in that it could very well have part of the calculations be going way back. Okay. One of those things I scratch my head and go, why did I do this? But anyway, it's we got three. Oh, I tell you, let's do the easy part first. Okay, sales. Price. 30,000. It is. Okay. So these are the sales. Sales are easy. Well, generally they're easy. We just had a chapter where the sales weren't so easy. But for most things like this, like the inventory stuff, it's not too bad. The sales are usually pretty straightforward, unless they have some special coupon or something we have to split out. Okay, now for the really fun part. $80 plus 120 plus 200 is 400, I think. Okay, we got to multiply each of these out. 17,200. Again, make sure you check those. Okay, so I'll come down here and cheat and see how I put it in up here. Average cost per unit. Okay. Okay, so we're going to take the 17,200 and we're going to divide that by 400 units. Will equal some number. I got 43 even. Is that what you guys got?
That's what I got, yeah.
Okay.
Yeah, I also got that.
Okay, thank you. You're a little worried, yeah, that can't be right, is it? All right. Okay. So it's $43 per unit. And let's see, I think we just did cost of goods sold. And again, there's only one. The nice thing is it's only one number, so it can be the whatever you sold here. I don't know if putting in all these arrows is helpful or not, but so we sold 300 units. The cost of those are $43. Let me do something here. I think I did this last time. Try to make them similar. $12,900. All right, so this is our cost of goods sold. We sold 300 of them. We sold them for 30,000. We paid 12,900 for those, and that's what we're gonna put in our calculations down here. So sales 30,000. One. Here we go. Cost of goods sold. And let's go to our gross profit. $70,100. So that's how much money we made on the sale of these. Ending inventory. Cheat one last time. Okay. So the other things that are not sold. How many things were not sold?
100 units.
Yep. Yeah, we had a total of 400. This is what would be, you probably put this in, this would be available. 400 units. We sold 300, so yeah, there's still be 200. Okay, so those are the units of units available. Okay. So say 100 unit, units. We'll put it down here. Oops, I'll do it. So average cost per unit, we use the same number for both. 4,300. Oops. I guess we need the 4 and the 4,300. Supposed to be a total, supposed to be our ending inventory. And again, that's just the, this is what was not sold. We didn't sell 100 of them. And at $43 each. So this would be our beginning inventory at the next, for going into what are they sold? January, going into February, those would be our beginning inventory. And as average cost, whatever we buy, we would just pile onto the 4,300. Whatever units came in, we just pile onto the 100, and that's how we would keep going on with this. Okay, now perpetual inventory. This one's fun. Perpetual inventory means that we calculate the cost of goods sold after each sale. So after each sale, we calculate what our cost of goods sold is at that period in time. Okay, so this can be a little bit tricky. All right, let me think I want to do. Oh, I know. Let's do the sales first. Let's do the sales first because these are going to be the easiest. We sold 90 units. You can put that in as two different ones too. You can put them in separately. But I'm gonna put them in together. 90. And if they were at different costs, I would put them in separately. But, or excuse me, separate prices, I would put them in separately. You could be you sold them at different prices at different times. Okay, so let me use this. And again, you could definitely put these in separately. Maybe I should. I'll put them in at the same time. So sales. Yeah, the reason I'm just doing it at the same time because it's the same price. If the price were different, I would have to do them separately. $4,050. Okay, so this is the money coming in. Okay, now this is where it gets odd. We sold these 30 on the 7th. I'm going to take this off. It's in here. Okay. Now on the 7th, coming down here, we have to calculate the last ones in that were in on the 7th when we made this sale. So which level will we take it from? The beginning, the purchases on the 13th, or the purchases on the 21st?
21st?
Nope. Remember, we're doing this at the time of the sale. Now, okay, now I'm gonna stop sharing for 1 second. Now remember, after each sale, so on the 7th, we have to make a journal entry. It'll be automated most likely, but there's gonna be a journal entry made that's gonna say, okay, this was sold on this date, and we took the last ones in that were in on January 7th. So anything that we got after January 7th, it couldn't be in the last in, first out. Now, if you take it for the period, excuse me, you're absolutely right, go to the end. But this is perpetual. So this is after each sale, we're going to calculate it. And that's what's kind of strange about it is it's going to be last in, but at the time of the sale, not at the end of the period. So perpetual inventory, while like a lot of companies will use it, it's also kind of a pain because it's whatever was last in at that point in time. Now, I'm going not gonna fuck up the issue yet, but there's there's something I want to talk about for FIFO, but okay, so on the 7th, I'm sorry, I'm coughing like crazy for no reason. Which one must have this come from?
Would it just be the beginning inventory on 1-1? Because that's all we know about, like at by the 7th.
Exactly. And I know I should have left more room on this. I should redo this one. Because you guys can't do that on your paper if you're okay, so we sold how many units? 30 units. Okay, so that is going to be our, we're going to use that for our cost of goods sold. And so what we're left with in that, excuse me, from that first inventory, the beginning inventory, we're going to be left with 10.
Professor,
Yeah.
would for the sold 30 units on 1-7, we sell the 30 units at $45 a piece and not 30 at 20?
This is the selling price. Yeah, we sold them at 45. However, the cost of it, I should say, oh, the cost of goods sold. I'm sorry, I see what you're saying. Cost of 30 units sold. Thank you. Let me clean this up a little bit. And you are absolutely right. Well, let's make those, I'm gonna make those turquoise just so we know that those are different than the other ones. And there's 10 left. Excuse me. So from that beginning inventory, we sold 20 of them. So this will be in our cost of goods sold, 30 at 20. That's what our cost was for them. We sold them for 45. Our cost is 20. So whatever that came out to be. And then let's go to the next sale. I'm gonna make this one green. How about keep them separated? On the 26th. What were the last ones in on the 26th? Which level? Which date of inventory?
You could use the 13th and the 21st, right?
Yeah, you start out with the 21st. Like these were last in before those. So we start out with this. Now, if we don't have enough, we will go to the next level. But let's see here. I think we have enough for this. Okay, so cost of units. I'm going to copy this down. This is easier to do. Cost of 60 units sold on 126. Okay, it looks like we can get them all from this layer. And so let me, what's left in this layer? $20. Why does this look confusing? Okay, so I know I'll do. I'll take these off the. So this is what's left in our inventory, the ones that are not highlighted. How about? So these yellow ones came from the beginning inventory in the first. These green ones came from the 21st, was the last ones in. And so these ones that are still all that are not highlighted, those are the ones that are still left. This will be our ending inventory. So notice how kind of wacky this one is. It's still LIFO. It's LIFO, but if you do it perpetually, yeah. So 31 came out of the beginning inventory. We didn't do anything on the 13th, and then from the 21st, the last one's in, we took 60 out of that. So there's still 20 in that layer left over. All right, let's calculate the cost of goods sold for January. Okay, so cost of goods sold. Hey. Okay, so we're gonna take the first sale. Okay, so we have units. We had what, 30 at 20. $600. This is wrong. This would be 30. Oh, I know what I did. Okay, so cost of 60 units sold on the 26th. We had 60. The cost on the 26th was $30 each. And that is a unfortunate coincidence. This 30 and this 30 are not the same 30s. I should have picked that up earlier. Okay, what's that, 1800? Pretty easy calculator. Yeah. So this will be our cost of goods sold, the total of those two. 2,400. And again, these ones that are, I don't know, maybe I should make them a color. The ones in red are the inventory that is not sold. So we sold 30 of the first inventory. There's still 10 left there. didn't sell any of the middle inventory, the 13th. And last one in. We still have 20 in that layer that was not sold. All right. Oh, let's see our sales. $4,050. Our cost of goods sold. And our gross profit or gross margin. 1650. I think that's right.
That's what I got.
Okay. Okay, so we sold the 24. So here's what's left. These are what's not sold. And just well, I really used up a lot of real estate here, didn't I? I'm gonna move this down just to get them together. This is the last page of it. I got another one. Kind of twisted person am I? All right. Okay, so this is still the one that we're working on. We'll put this one down further. Okay, so what do we still have left? I don't even know if I have enough room for this. I gotta add a row. Okay. So ending inventory. So from the beginning inventory, we have some. From the 13th, we still have some. And from the 21st, we still have some. Let's see, we have 10. And $20. We have 70 at $25. And we still have 20 left. $30. Oops. What's the way? 17. I better do it.
Should be 1750, right?
Yeah. Yeah, 600. Oh, got the wrong number there. Okay. 25.50, I think. So this would be what is not sold. So we would start out with these 3 layers going to the next round. This is the only one I have. This one. Let's skip this one. I'm gonna do one like the book, which I think is a little bit. Well, I'll tell you what. Well, is this the first one we did? Wait a minute. I mean, last and first perpetual. That's the only one we did. Let's do it. We gotta do this one. We gotta do one more. Sorry about that. Okay. Oh yeah, this one's different. Okay. No, it took so long. It seemed like we were doing more than one. Oh, we're almost time for break. Okay. We'll do this one. We'll take a break. All right. So we had 2 sales. The one on the 7th came from where?
1-1.
1-1.
Because 1-9 didn't come in yet, right?
Correct. So this would be. Let me look back and see how I wrote it up here. We sold 100 units on 1-7. The cost of that was 8. And so we still have 30 in that layer. If you're wondering why I'm doing this as we're going along, because it is possible that we sell up through more than one layer. You know, it is possible to go through multiple layers here. One of the reasons I'm doing this not in the book problems is that some of the book problems have like dozens of these, and so you can imagine how much fun that is, and you get the idea of what we're doing by doing this. Okay, so that's the sale on. That's that sale. The sale on the 7th. Where did the sale on the 12th come from?
115.
Nope. Close.
Oh yeah, 1-9 because it didn't come yet.
Yeah, yeah. So this will be. Wait a minute. I'm in the wrong spot. Hold on, give me a second. So we sold. I don't want to do that. Cost of 200 units sold. Give me a second here. I'll clean this up. 200 units sold on 112. Okay. That was at what price of it was it at? $10. I'm sorry.
Those should be at 10.
Okay, so from this layer, we still have 80. Sold 200 of them. Yeah, I think it's 80. 80 left. And maybe I should put these in the same. I don't know. It's hard to say whether they would be. I don't know if this makes things worse or it's hard to tell. Okay. Well, let's do the simple one then. Sales units to, oh, we can add these up because they're sold at the same price. If they were sold at different prices, we'd have to do them separately. I'm gonna put them in all at the same time. In future handouts, I will make those so that they are. 320. Okay, so 300. Just shake things up. Although sometimes it's like you put little things like that in there and it just becomes, it's like that's not really what we're talking about. That was a previous chapter, the revenues. Yeah, it's there, but two to 6,000. So that's our sales and cost of goods sold. I'm going to cheat and see what I did up here. Okay. You can leave me. So cost of goods sold, we're going to take these. And plug them in. Okay. So we have units, under units. So the cost of those units were $8. And we also sold 210. A cost of 10. And so this will be our cost of goods sold. Okay. Gross profit. Gross profit. And now the really fun stuff. So these are what was not sold. Just gonna copy these 3 layers down. What the heck? Let's try it. Let's do that correctly. I'm showing you how to do it incorrectly, but then I thought maybe you don't want to see it that way. You need one more row. You do. Okay. Sorry about that. Ending inventory. Let's see from the beginning. Eight, 10, and 7. Yeah, you're right. Yeah. $13.90. Yeah. So that would be our ending inventory. What a pain, eh? All right. Let's say be back at 317.
Will we go over the homework ones after the break?
Yeah, I'll put those in now.
All right.
Find them. Here we go. Let's do the first ones first.
I think it was 8 and 5, right?
Uh, yes, it looks like that. All right, let me see here. Let's see if I wrote it up. Okay, let me see. This is first in, first out.
Professor, isn't 5 and 8 like literally copy paste? Isn't it the same thing? Or is it different method?
That's right, you guys can't hear me. I'm talking to myself. Any questions on this one? Then number 5, you guys get that?
Wait, so what were the different methods that you had to use for 5 and 8? Because it's the same data, right?
It's exactly the same data. Um,
So how do you know when to use because it says last and first like last and first for 8, and then for 5 it's the first in first out. So like you would just take so first in first out you would just like literally start from the top units and then go down.
yes, and
Like
let me do this, and this might make it more apparent. I think it's kind of a naming thing too. First in were the first ones that were sold. It is first in, first out, but what they're really talking about is the first ones that were first in were the first ones that were sold. So we're assuming that these came from the beginning inventory, which is probably the way they probably did. This one's first in, first out is probably the way most things work. First ones in are the first ones you sell. So yeah, so you're assuming that they're the first ones that are sold. And so yeah, you take it from the beginning. If they're first in, you take it from the beginning. And it's exactly the same data. Exactly the same data. But you're assuming that the first ones are the first ones we sold and the last ones are the last ones that we sold. So these are all the first ones. Ooh, don't do that. These are the first ones that we had in. That's where they came from. We assume that they were, now we really don't know which ones they were probably, but the assumption is pretty well, it's pretty good that probably the first ones ever, the first ones sold. You don't put new ones on more on the shelf until you sell the other ones. So first in, first out is probably the one that's most accurate as far as the actual flow of inventory. And what you'll be left with are the ones that are the newest. These are the ones that just came in or will be left in your inventory. You sold the ones, the earliest ones were sold, and these last ones will be the still left in your inventory. And then these will be the beginning inventory of next period, and these will be the first ones sold. Next period, these are going to be the first ones that are sold, the ones from the 9th in January. And again, this FIFO is probably the more accurate, the more accurate as far as the actual flow of goods. So you're taking the first ones in. So let's go down to contrast that with this one. Blah, 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 blah. So the last one is in there, the first one's out. What we really mean by that is that they're the last ones are the last ones sold. Now, maybe this is probably not the way most of it is. The last in, first out, I think I told you, it's a theoretical one. It's theoretically the last numbers in are the more accurate as far as the actual cost, and so therefore the more accurate as far as the actual income. This is what economists will tell us. Last ones in are clearly they're the more relevant of the numbers, and so that's what you should be using. Now, nothing flows that way, and these are theoretical. This part of the reason why we have LIFO and the other sorry, that we have LIFO and other countries don't is in America we go crazy over the income statement. We just go crazy over it, try to get exactly, no, don't cheat, don't, they get really nutty about the income statement. So they say, oh, the more accurate one is this theoretical one of last in, first out, even though nothing really flows that way. European countries have a more kind of balanced thing. Okay, it's a trade-off. You're going to mess up the balance sheet to make a perfect income statement. So we do have a kind of a little bit of a divide, but yeah, no other country uses LIFO, but the United States, and again, it's a theoretical best number, but yeah, so it is a little bit strange to think of that one. And if you're wondering why do we use it, I mean, yeah, because nothing flows like that. So last in, first out, we assume that the last ones in were the first ones sold. So last in, first sold, maybe we go LISO or something like that. Yeah, we're assuming that these last ones, so these are the last, they were sold first. Once we sold out of all those, we have to go up the ladder. This was the next last. And we never did get to the beginning inventory. So these are what was left over. These are not sold.
So does it all just depend on like what the company wants?
Yep. Yeah.
And but you think the most effective way is like the first in, first out because it like shows you exactly like the old stuff that you got out and then like the new stuff when it comes to that date.
Yeah. And if you think about it, if you're looking at the income statement, yeah, the last in, first out is theoretically the more accurate. But however, you do that at the expense of your balance sheet because, down here, this is last in, first out. This inventory of 1/1 of 130, this might sit around for 30 years. If you never sell down to it, you could have a 30-year-old number sitting on, maybe 30 years from now, these go for $80 a piece or whatever they are. But you'd still have this $8 sitting on it's it's a ridiculous number. And you definitely have that where countries will have, companies will have ancient numbers as their cost because of that. They'll have these. So yeah, your income statement's more accurate, but your balance sheet is messed up because it's not, and so and another thing too is companies look with these smaller assets, they can sometimes can look more profitable than they really are, because um, their assets look lower. It's like, wow, look at all these sales are getting off of all the small inventory. That inventory is small because those numbers are from 20 years ago. Those are not real numbers. Those are not reflective of of your return on your assets. Oh, this is like, yeah, okay. So any question on that? So yeah, it is. And it used to be that they would there'd be different industries that would, kind of flock to LIFO or FIFO or average cost. But more and more companies are getting away from the LIFO. And I think I told you this. I don't know. I'll have to check and see if it's still required. It used to be required by the IRS that they use LIFO. And so you had this weird thing where, you had international companies, you were prohibited from using it. For US to file your taxes, you had to use it. Okay. Let's see what we'll get done on this other one, this other handout, and then we'll see what we'll have on the test. Handout 2. This is a perpetual LIFO. I don't know. Do you guys want to do this one? Well, let's do this one. Let's go ahead and do this one. This one is a little bit how the book has it laid out, and I think it's maybe a little more easy. Actually, I should probably start doing it on mine. Okay. So let's see here. I'm gonna check. I'm gonna jump ahead just to see. I'm gonna skip this one. I tell you what I'm gonna do. I'll put the perpetual LIFO on as a extra credit. It is wacky, and it's because it's perpetual and it's LIFO that it's the last end. And if you're wondering why, the perpetual FIFO is bad, and I'll tell you why. The first ones in are going to be the first ones in. You know, it doesn't matter whether you're doing it at the end of the period or the beginning of the period. The first ones in will be the first ones in. So FIFO, you'll come up with exactly the same numbers in total for your inventory, for your cost of goods sold. Perpetual life FIFO and perpetual periodic LIFO and perpetual LIFO will give you exactly the same numbers. I said that wrong. Perpetual FIFO. The first one's in will always be the first one. FIFO, it doesn't matter whether it's perpetual or periodic. LIFO is the wacky one. Even wackier than that is the average cost one, which you get into monstrous numbers doing that as a perpetual. So much so that I don't know that I've ever taught it in a class. Maybe I have, but because after every sale, your units change. After every purchase, your units change and your costs change. So after every sale and every purchase, it gets remixed. So perpetual average cost is probably the biggest nightmare. But close second is the perpetual LIFO. So I'll put perpetual LIFO on as a extra credit. So the perpetual one means after each sale, and that'll be like the last two that we did, and I'll put that on the problem that those are like the last two in the handout. I'll put references to which pages there are in the handout for them. Okay, I'm gonna do some of these that we're gonna do next are kind of a little bit easier. Okay, so let's go to page and then handout number 2. Let's go to page 2, and the lower of cost or net realizable value. This one's kind of new, and one of the reasons why I want to talk about it is the things that are new are more likely to appear on the CPA exam than the older things. So this one is somewhat new, and this one was really set up like this so that it kind of matched up with the international standards, which is a good thing. It's always good to have the same between one and the other. So here's the problem they have. You have this cost of something on your books, and what if you can't sell it for that? What if you have inventory that you can't sell for what you have it on your books for? Well, what we have to do is write that down to what how much are you going to get for it? So if you have the stuff on your books you're carrying it on your books at the cost, but the cost is more than the selling price. Notice that you're overstating your assets. And that's a problem. You're overstating your assets. So what we have to do is write down that inventory to what we can sell it for. So that's all this is lower. So this is kind of like lower of cost, kind of like lower of cost or market, but they call it lower of cost or net realizable value. Okay, so we go through each one. Determine the carrying value of any inventory, assuming the lower cost and net realizable value rule is applied to individual products. Okay, it can be also for product types, but they're doing it for each individual products. Okay, this is actually not too bad. Which is lower for product 101, the cost or the net realizable value, what we can sell it for?
Like, are we literally just looking at like the numerical values and seeing what's lower?
Yep.
So the total net realizable value.
Yep, what we can sell it for. So we can sell it for 100,000. Ooh, Mark is putting crazy things on the screen. Let's do that, not do that. Yeah, so it's literally, Mark is still putting crazy things on the screen. It's literally the lower of the two. You're just gonna go down here and say, okay, that one's lower. Now, one of the important things to note though is you don't write it up. You don't write inventory up to a higher level. Look at this. Okay, so this is what, 90? So this is 90,000. We can sell it for 110. So if this is fine, it's not any problem with it, obsolete or anything like that. 103 is on the books at 60. We can only sell it for 50,000. So we are going to write that down to 50,000. Let's get the correct. So these are just the lower of each of these. Yeah, last one we got these on the books at 30,000. We can sell them for 50, so we're going to leave it at 30,000. So that'll be. Okay, so some of these are impaired and some of them are not. Okay, so let's see. We'd have to add up this lower of cost or net realizable value. So this is what we're going to have on the books at lower of cost or net realizable value. That. And again, this has been around maybe like maybe 3 or 4 years. I can't remember, to be honest with you. Maybe 5 years now. Okay, excuse me. Adding all those up, it comes out to yeah. $207. Okay, so this net, and by the way, if you're wondering what is the net realizable value, the realizable value is what um you could sell this for minus your selling price, your costs on it. How much are you going to get out of it? So if if you sell something for, so if these would be sold for 105,000, and then there's 5,000 of selling costs, maybe commissions or something, that would bring it down to 100,000. So whatever it costs to actually sell it, which by the way is a little bit strange if you ask me, because usually those are, we separate out the selling costs from the product costs. Even though we do that the value of the inventory, when we actually go to the income statement, those two are separated. We have cost of goods sold, and then we have selling expense in our operating. You got to remember doing that. So, yeah, it's a little bit strange that it's in there, but it's just a matter of finding out what it's worth, basically. Okay, so do we have a loss or not? How much is the loss? We do have a loss. How much is it?
30,000.
Yep. And when you're doing this method, you can only have a loss. You can't have a gain. So, if the cost is lower than the net realizable value, it's just you just leave it alone.
Wait, so why do you want to take the loss? Like, why wouldn't you want to? Do you gain more money then, right?
Well, it's actually it's not that you want it to be a loss. It's just that you have these assets that are overstated on your books by 30,000. Now, it's not all of them. And if they were doing that, if these were all from the same category, you would just leave it at the 300,000, because this would be 310,000. So if these were all in the same category and you're doing it by category, you wouldn't write anything down. But if they're doing it by product, and what happens is you say, when do you do that? A lot of times they'll do that when it's more volatile. When you have products that, the value of them fluctuates quite a bit. I don't know if it's fashion or something like that, so something that will fluctuate quite a bit. That's when a lot of times they'll do it by product. But if you did this by category, it would the net realizable value is 310. You would just leave it at 300. But they're doing it by individual products, and it says assume the write downs are common. So this is something that is probably an industry something that that some things are hot and some things are not. And so if write downs are common, then it's just part of your normal business. And what you would do, I think they gave us a date. Nope, they didn't. Let's say 12/31. And what we would do is, did I already have that 30,000 sitting in there? Oopsie daisy. Yeah, so this would be a debit. Well, first of all, you're gonna take it out of your inventory, and it'll be set up right. So inventory. Going down, I spelled inventory right. Wrong, I didn't say. So inventory is going down by 30,000. And this would just be added to your cost of goods sold. And cost of goods sold is similar to an expense going up. It's similar to this. It's actually not, it's actually that they call it cost rather than an expense, but so your asset's going to go down and your expense is going to go up. If it was an unusual event, you'd probably separate it out. Okay, so and I made a note here because this is kind of where we're at right now with this stuff. Okay, let me start with the international standards. It'll be easier. So the international standards, they use the what we just did, the lower of cost or net realizable value. They don't allow LIFO, so there is no ruling on LIFO for the international standards. You can't use it anyways. All right. So going to US standards, we in the US, thankfully, is a part of kind of making everything similar so we can, you can have investing from one country to another without too much difficulty. And I think it was a really good move that they did was that for the inventories that are the same, the LIFO and FIFO, we match the same thing as the international standards. So that's good. However, we still have this strange one hanging out there, and this one still goes by the old US rules. And the old US rules are really wacky. They have ceilings and floors and all kinds of stuff that's fun. Literally the problems they take an hour. It doesn't usually take like an hour to do any sizable problem in them. But anyway, so this is the one that's a holdout. Hopefully, I would hope that in sometime in the future here that it gets changed over to this one. But as of right now, it's not. It still goes by these old US standards. Okay, so here, let's talk about what's going to be on the test. How about? I'll put we're gonna have one of these on. So I'll tell you, I'll make up a list. How about? Hey, okay, so here are the three that we're gonna have the three that are similar to the handout. We're gonna have FIFO, which is like problems, I think 3, 4, and 5. And all these listed on the problems. FIFO periodic. 2, average cost. Wait, I think we did LIFO a second. LIFO periodic. And now problems 6, 7, 8. Oops. We're going to have a average cost. Periodic. Okay, and I will put a LIFO perpetual.
These are the questions that are going to be on the test, right?
Yeah, these are gonna be on there.
Okay. Wait, so are there questions from like this handout the second handout we opened up today on the test?
Yeah, I'm gonna put the net realizable value.
Like the one we just did?
Yeah, the average cost.
Okay.
Yeah.
Okay. And then do you want us to do the other ones for homework on this handout or just submit this
No,
hand?
no, no, no. Just do what we did here. It'll be fine. This is, all this stuff. We could literally spend like half the term on this chapter. There's a lot in it, but um, you know, we choose our fight. So, like a professional, this is like problems, handout problems.
So we could just submit this one handout with the one question done?
Yes.
Okay. Thank you. Sorry for so many questions.
It's like, no, yeah, it was. I'll tell you something funny. I've been doing this for years, but I still sometimes. So this would be. Oh, I'm sorry. This one's extra credit. I still think, oh man, we'll get done early today or something like that. It never turns out. But at the same time, you got that. There's only so much you can put in. So okay, so this will be extra credit. And by the way, extra credit, you're not going, you can't lose any points on that. And if you try it, you're going to get some points. So that, okay, so this is, I should say this is handout one, probably. I should put that in there. One, and what did I do? I didn't put it. Oh, all right. Five. Um, oop, this will be a handout two. The only problem we did on, which was I got this for FIFO and average cost. Those are the only two that you would use this on. You wouldn't use it on the LIFO. Bah, what was 18? And again, you just pick the lowest of the two and then make the journal entry for reusing it. So what we'll do, so each of these, we'll make each of these worth like 25. This will be 25, and this will be extra credit, probably like 6. So this will be the chapter, and I'll get this out tomorrow. I'll be emailed by tomorrow. Oops. And I will get the I plan on getting the grading caught up. I know I haven't done any grading since Sunday, I think. Um, It's nothing to do with this class. The school, everything has to be turned in for all these committees we're on by today. So everyone's been running around. I've been in so many meetings. It's like, they're all this week, and half of them I have to present stuff in. But anyway, yeah. So it'll be better going into the future. Any questions? Does anyone want to see the 5 and 8? Oh, the exam's due tomorrow. I will definitely. that is wrong. And so is all of these are wrong. I'll fix all of these. These are all due the 21st. Thank you for letting me know. Yeah, oops, no. These are all due the 20. These last these all three of these are due on the 21st. I will fix that. As soon as we wrap up this meeting, I'll fix it. Oh wait, can you see what I'm doing? No, you can't. Here we go. These will all be fixed by in 5 minutes, let's say. I'll leave it up so I remember to do it. Any other questions? Did you want to see 5 or 8? No, we really just want to go. Okay. All right. I will see you guys next week, and tomorrow you should get the test will be emailed to you.
Thank you, Professor. Have a good one.
Thanks, guys.
Think you have a good one.
Thank you, Professor. Thanks for asking all the questions too. I know I got a lot. Some might be stupid, but
No, not at all. Not at all. I'll
I
appreciate.
yeah, yeah, I also had one question. Do you teach a higher accounting class? I know I already picked my classes for the spring term,
Yeah,
but I really like the way you teach and show on Excel. Like most professors like to read off like PowerPoints and like from the books,
yeah,
and
yeah.
I don't really learn like that, but like I like
Oh,
applying it in the Excel file and actually doing the numbers and all that stuff. Like I learn better that way.
yeah, yeah.
And I really appreciate the way you like teach and all that.
Oh, yeah, yeah. I do teach. I teach everything up to. The only thing I don't really teach are the tax classes. We have people that teach those, and some of the research classes. But most of the other ones I teach. So I'm not.
Okay.
I'll be honest with you, I can't remember what I have next. Do you remember?
Okay.
Yeah, yeah.
No,
So
no worries. I know I got one. I don't know if you know him, but Richard Arredondo.
yeah, yeah.
I've done a few classes with him before, and I'm doing another Zoom with him next semester. But yeah, I couldn't get any classes with you again, I don't believe. So, do you teach on campus by any chance, or do you only do Zooms?
No, I teach on campus. I actually prefer teaching on campus, but
Okay.
yeah, yeah. I definitely teach on campus too. And in fact, I think I could be wrong, but I think all but one of my classes is live.
Okay.
So, well, I hope.
Okay.
Okay,
All right. Thank you very much.
thanks.
All right. Have a good one, man.
Hello.
Bye.